Welcome back. As trade war tensions between US and China escalate, there are possibilities that China may hit back by selling US bonds. Prashant has now moved over to the big wall for an explainer.
Well, thanks very much for that. Will China hit back at Trump's tariffs by what some have called, actually a guest in the morning called, the nuclear option, dumping US treasuries, but they're US bonds. It's the most powerful financial weapon in China's arsenal. There's growing chatter that China may retaliate by doing this, not just with words or counter tariffs, but with real pain in the bond market. Such a move could serve as a powerful financial market deterrent, much like weakening the yuan's daily fixing. Lower yuan makes China's exports more competitive. Selling US bonds will raise the cost of funding for US government and send a clear message. You sell more bonds, yields go up, and that's essentially your risk-free rate. So cost of financing and rolling over US debt becomes much higher. Of course, the message is going to be that don't test our restraint. Now, how big is China's holding of US government bonds, right? I looked at the numbers, and the numbers I have is this. China holds about $760 billion in US treasuries. That's about 9% of all foreign-owned US government bonds. This is down from a peak of 28% in 2011. So this is not a percentage of the total US treasuries outstanding. This is a percentage of what foreigners own, and foreigners own about, as the graphic says, 30% of US treasury debt. So 9% is what China owns. Selling US bonds hurts China too, and that's the problem. And that's why many are saying, they won't do it. It's simply because they are the largest holder, and a fire sale would devalue their own reserves. It's quite similar to how in stock markets we say large shareholder selling, and that crashes the stock because they are the big supply, and there is no counterparty on the other side. One other line of thinking is this: why sell? If you look at the maturity of bonds which foreigners own, 60% of foreign holding of US government bonds are in the 0 to 5 year tenor. So they're not long dated. And I'm assuming these numbers hold true for China official reserves as well. So the thinking is, they could just simply let this run down without reinvesting back in bonds or buying new bonds issued by the US Treasury. In any case, if you look at Chinese reserves over the last couple of years, and not just now, one thing is clear. They're buying more gold and they're buying lesser of US bonds anyway. And this has been happening already. Now, while we're only talking about China for now, the bigger sort of longer term question is this: will we see overall foreign demand for US bonds, US government bonds, permanently impacted, caused by all this, for the lack of a better word, nastiness on tariffs and trade? And I think it's an important question to ponder over, because US government finances a lot of its spending through this route, and people queue up around the world, or rather for the decades now have queued up around the world to buy this because it's considered safe and all the other reasons which go with it. The Chinese central bank, the PBOC, People's Bank of China, has a publicly stated goal in any case to diversify its reserves, move away from the US dollar and reallocate into other G10 currencies. This pivot makes more sense now in any case, even if he did not have a trade war, because the rate differential between US and the rest of the G10 countries is narrowing. So the attractiveness already, that gap is narrowed quite a bit. So it's a space we need to watch closely. As that statement just a while back said, that white paper, apparently they're ready for negotiation, and that's the route this will take, and it won't come to this. The point is this: they don't even need to sell it. If it comes to this, we're not talking about a wholesale sale. There's no buyer on the other side. The Fed will have to do QE and bump up all these bonds if China decides to sell and hand over dollars to China. We're not talking about that. But the point is, even a small, chunky sale could make the point in this trade war that we will match you in escalating this war step by step. And I think that's what we are looking at here. Let's actually welcome in Vaibhav Sanghavi, who's now with us to run us through what he's making of things. He's CEO of Ask Hedge Solutions. Vaibhav, beyond the big picture but it's all big picture now, and not very many people are looking at sort of bottom-up stories because everything is being brushed aside in the same color. What are you doing, Vaibhav, at your fund? You guys can do long, short. What's the sense, and what are you up to?
Prashant, I think markets in a way are extremely kind of volatile, in the sense that every day is a new day, right? At the end of the day, what are the developments? and what is the subsequent impact in terms of the portfolio, it's extremely tricky to kind of take a medium-term view on that. So, from being a long short fund and having the liberty to kind of go on the opposite direction as well, kind of helps us to kind of hedge the portfolio effectively during these kind of time periods. But when I saw what you had to mention about the China thing as well, I think one of our contention also is that on the trade tariff, it is not only about tariff. I think a lot would go also into in terms of the negotiating kind of deal, in terms of course, bridging the trade gaps, but two, in terms of the geopolitics, and three, in terms of kind of funding the US deficit by buying more US treasuries as well. So my sense is basically it will be all part of one big negotiating deal, which will come about with all the countries going forward. So interesting times, tricky times, but at least in the next couple of months, I think the turbulence will continue to be there on an overnight basis.
You were talking about your long shots, Vaibhav. Which side, how you're positioned currently, and how has it changed, say, in the last couple of months or so?
See, I think over the last couple of months, I think we had written a note in terms of what we are thinking in terms of the change. And of course, one of the big risk factors was Trump tariffs in that. But what we are seeing, from FY26 and 27 perspective is, one, from a domestic side, we are extremely positive on the whole consumer segment. Now, it's not only about the defensive nature of the consumer segment, but also because that we have seen after 8-9 years of government's sole focus on the supply side to now a combination of welfare and in terms of the consumer rebates as well, in terms of the tax. So what we do think is that increasing the disposable income in the hands of the consumer at the end of it will see to that the momentum in spending kind of increases, and especially into sectors where there are good experiences, or probably going to restaurants, malls, and over and above some amount of discretionary items as well. Lastly, to be followed by the staples. So all in all, the whole consumer space is something which we are bullish on. And at the same time, what we are turning a little kind of to neutral from being very positive is basically the banking sector, purely because as we look at rates kind of come down, we may see some amount of pressure on the margins. And as we see the turbulence on the economic side, where the exporters will have some tough time, maybe probably some amount of stress on those kind of books as well. So that's a segment which we are currently getting neutral from being bullish, from a portfolio perspective.
Any sectors which you're short on, cautious?
So all the global sectors, including metal mining, probably also on autos who have a global exposure. I think those are the sectors which we are avoiding. And lastly, I do think that if the global growth is going to weaken, then it will have a direct impact on the cap goods industrial side, as well. So industrials is something which we should probably avoid as well, purely because the valuations there are not cheap in any case.
And IT pharma? Vaibhav?
Yeah.
You spoke about export-oriented sectors like metals or global companies auto companies with a global facing. But what about IT and pharma?
See, IT, I think it has been beaten down really badly, and probably we are looking forward to the next 10 days in terms of the results and the guidance. Not that it would be anything kind of exciting. What we may probably happen is basically because of these results and the guidance, we may find some amount of bottom happening post the declaration of numbers. So let's wait for that. In our view, when the free cash flow yield kind of starts to look pretty attractive on these companies, there is some amount of bottoming will be made probably in the next 10 to 15 days. So we will have that view. Pharma is, again, wait and watch. Let's see what happens from a tariffs perspective, and then we'll probably take a call on that.
I think I just saw Coforge up on the screen. Coforge high was about 10,000 rupees. It's fallen to about 6,000 rupees. And Rima, I think I remember speaking to Sudhir Singh.
Yeah.
He's
very bullish.
He's like front foot and everything first, right? I mean, But I don't know if the commentary has changed. The last time, of course, this was all not there, this tariff talk, etc. So we've seen very, very sharp falls in that sense. And tomorrow, of course, we'll ask TCS, I mean, what are they hearing? And if they're able to, if they've heard anything so far, and I think that should set the tone beyond the numbers for Jan to March. Vaibhav, any thoughts on OMCs, oil marketing companies? Again, oil prices have come off very. The only thing is, marketing margins are very robust right now. Will oil stay here? Because in COVID, there was real demand destruction, right? Right now, the destruction is mostly financial markets. So the price of oil can also swing sharply based on what happens to financial markets.
Of course, Prashant, I think while that's a second order or third order probably impact in that sense, but what we have seen in terms of increase in excise duty by 2 rupees per litre, in our view, the OMCs may not be allowed to make profit in excess of a certain amount, which probably will have to be contributed to the government coffers in that sense, which is to build up some amount of cushion on the fiscal spending side. So my view is that as oil keeps on correcting, while we see some amount of decrease in prices on the consumer side, but some part of, again, will kind of keep on chipping away to the government kitty as well. So in that sense, yes, current profitability looks good, but as global growth weakens, refining margins will start to come under pressure as well.
Okay. All right. So not a positive look. I think there was an Ambit note today. They are talking about between 50 and 100% upsides here for oil marketing companies. Sort of in the morning, look for it. But I mean, there's a fair bit of interest here, especially now with that marketing margin story, oil prices dipping, etc. But as Vaibhav said, there are the margin, of course.